Silver just broke all-time highs, and then suddenly started falling. Is this the beginning of a historic rally, or a trap most people won't see coming? Silver has always been more than just a shiny metal. It is a mirror of the global economy, a bridge between industry and investment, and one of the most volatile assets in the financial world. In recent years, silver has captured global attention by reaching all-time high prices, shocking markets and investors alike. But what pushed silver to these historic levels, and why does it sometimes fall sharply even after strong rallies? To understand this, we must look closely at market demand, supply limitations, and the economic forces that move prices up and down. Silver's rise to record highs did not happen overnight. It was the result of years of pressure building quietly beneath the surface. Inflation fears, global uncertainty, currency weakness, and a shift toward renewable energy all played a role. When investors lose confidence in paper money or expect central banks to lower interest rates, they often turn to hard assets. Silver benefits strongly from these moments because it is cheaper than gold and accessible to a wider range of investors. As demand increases, prices begin to climb rapidly. At the same time, silver is not only a precious metal, it is also an essential industrial resource. This dual nature makes it unique. Unlike gold, which is mostly held for investment or jewelry, silver is consumed. Once used in electronics, solar panels, or medical equipment, much of it is not economically recoverable. This constant consumption puts long-term pressure on supply. When industrial demand rises during economic expansion or technological growth, silver prices respond aggressively. One of the biggest drivers behind silver's recent all-time high is the global push toward clean energy. Solar panels rely heavily on silver because of its unmatched electrical conductivity. Into renewable energy infrastructure, the amount of silver required increases year after year. Electric vehicles, charging stations, and advanced electronics also consume more silver than traditional technologies. This demand is not speculative, it is structural and long-term. Investment demand has also surged. During periods of economic instability, geopolitical tensions, or stock market volatility, silver becomes a safe haven asset. Retail investors buy coins and bars, while institutions increase exposure through futures and exchange-traded funds. When large volumes of money flow into these instruments, prices can move very quickly. This is why silver often experiences sharp rallies in a short time. However, rising demand alone does not explain record prices. Supply plays an equally important role. Silver supply is unusually constrained because most silver is produced as a byproduct of mining other metals such as copper, lead, and zinc. This means silver production does not easily increase even when prices rise. Mining companies cannot simply decide to produce more silver unless production of those primary metals also increases. As a result, supply reacts slowly to demand shocks. Another major issue is underinvestment in mining. Developing a new mine takes many years, often more than a decade. Environmental regulations, high costs, and political risks discourage rapid expansion. Existing mines also face declining ore grades, meaning more material must be processed to extract the same amount of silver. Recycling helps, but it cannot fully close the gap between supply and demand. These factors have created a persistent supply deficit in the silver market. For several consecutive years, global demand has exceeded total supply. Inventories stored in major exchanges and vaults have steadily declined. When available physical silver becomes scarce, buyers are willing to pay higher prices, pushing the market upward. This scarcity is one of the strongest reasons silver reached all-time highs. But if the fundamentals are so strong, why does silver sometimes fall sharply? The answer lies in market behavior, macroeconomics, and psychology. After reaching high levels, traders often take profits. Large investors who bought at lower prices sell their positions to lock in gains. When this happens on a large scale, prices can drop quickly, even if long-term fundamentals remain bullish. Interest rates also play a critical role. Silver does not generate income like bonds or savings accounts. When interest rates rise, investors are rewarded for holding cash or fixed income assets. This reduces the appeal of non-yielding assets such as silver. Even expectations of higher rates can cause prices to fall as markets adjust in advance. The strength of the US dollar is another key factor. Since silver is priced in dollars globally, a stronger dollar makes silver more expensive for buyers using other currencies. This can reduce international demand and put downward pressure on prices. When the dollar weakens, silver usually benefits, and when the dollar strengthens, silver often struggles. Industrial demand can also fluctuate. While long-term demand for silver in technology and energy is strong, short-term slowdowns in manufacturing or global trade can reduce consumption. Economic recessions, supply chain disruptions, or reduced consumer spending can all impact industrial usage. When markets fear slowing growth, silver prices may fall due to concerns about reduced demand. Investment sentiment is highly sensitive. Silver exchange-traded funds hold massive quantities of physical silver. When investors lose confidence or shift money to other assets, these funds experience outflows. To meet redemptions, silver is sold back into the market, increasing supply and pushing prices down. Another important factor is volatility. Silver is known for sharper price swings than gold. Because it is a smaller market with less liquidity, large trades have a bigger impact. Algorithmic trading and technical analysis also play a role. When prices break key support or resistance levels, automated systems may trigger large buy or sell orders, accelerating trends in either direction. Market manipulation concerns are often discussed in silver circles as well. While regulated markets aim to be transparent, futures trading can influence short-term prices. Large positions taken by financial institutions can create sudden movements that do not always reflect physical supply and demand in the real world. Despite short-term drops, silver's long-term story remains deeply tied to global transformation. The world is becoming more electrified, more digital, and more focused on clean energy. All of these trends require silver. At the same time, mining output is struggling to keep pace. This imbalance suggests continued volatility but also strong long-term potential. For investors, understanding silver means accepting its dual personality. It can behave like a safe haven asset during crises and like an industrial metal during economic growth. This makes it powerful but unpredictable. Those who chase short-term price movements may experience sharp losses, while those who understand the fundamentals can better navigate the cycles. Silver's all-time high was not an accident. It was the result of years of building pressure from demand growth, supply constraints, and economic uncertainty. Market downturns are not signs of failure but natural corrections within a complex global system. Prices move down not because silver loses value overnight, but because markets constantly rebalance expectations. As the global economy evolves, silver will remain at the center of important conversations about money, technology, and sustainability. Whether prices rise or fall in the short term,